students, welcome back to Accounting 1303, Introduction to Accounting 1. This is Dr. Mercado with you again. In this particular lecture, we are going to be covering content from Chapter 5, which deals with the adjusting entries and the worksheet. The specific problem that I will be covering with you today is Problem 5-17A. This is a very comprehensive problem, and I hope that it helps you complete some of your other assignments as well as learn how to complete this specific assignment. I believe this problem does not have a video in Cengage, so I am going to be showing you how to complete it, as it's a very important problem because you will be seeing this on your exam. Okay, so I will be taking the time to explain it to you. That way you have good notes as to how to complete the problem and you are prepared for when it comes exam time. So there's a lot of information on the chapter, and I am not going to go through all of it. All of you have to read the chapter so you can gain some knowledge about the concept of adjusting entries and the worksheet. Okay, I'm just going to highlight some key information from the chapter that I thought was crucial, but this does not mean that you don't get to read the chapter. Reading must always happen first, okay? So the first section that we're going to be dealing with is the end of period adjustments, okay? So why do we do adjusting entries, okay? So the textbook says that throughout the accounting period, business transactions are entered in the accounting systems, and these transactions are based on exchanges between the business or other companies and individuals. Now, during the accounting period, other changes occur that affect the business's financial condition. For example, they tell you that equipment is worn out, prepaid insurance and supplies are used up, employees earning salaries and wages have not been paid. Other examples might be that your rent, if you prepaid your rent, you've used up some of your rent, you've used up some of your supplies, things of those natures. So because events happen during the month that have not been recorded, we need to do the process of completing our adjusting entries. Okay, now the adjusting entries are prepared before we prepare financial statements. So we need to update all of our records with all of the necessary journal entries before the financial statements are prepared. Okay, now the adjustments are guided by three important principles. You do need to know about these three principles. So we have the revenue recognition principle that states revenue should be recognized when earned, regardless of when cash is received from the customer. So let's say, for example, you complete a job at the end of the month. You bill the customer, but you have not been paid. You still need to do an accrual to record that revenue that was earned this month, because we have to recognize the revenue when it was earned. We earned the revenue this month, even though we haven't gotten paid. So in this particular scenario, we would have to set up a receivable to be able to say, you know what, someone owes me money, and I'm recording my revenue for work I did in the month of January or February, whatever month it is, okay? So that's one type of adjustment that needs to happen, okay? So revenues are considered earned when a service has been provided or a product has been sold, not when it has been paid. So even if the product has not been paid, you still have to do a journal entry that specific month. We have to record the revenue the month it is earned, okay? So that's very important, first concept. Similarly, the second concept deals with expense recognition principle, and this principle states that expenses should be recognized when incurred, regardless of when cash is paid. Expenses are generally considered incurred when services are received or assets are consumed as a result of efforts made to generate revenues. The proper matching of revenues earned during an accounting period with expenses incurred produce the revenues is often referred as to the matching principle. Okay, so we have to match the revenues and the expenses in the period that they incurred. Okay, this approach offers the best measure of net income. So let's say, for example, for the expense recognition principle, you get your water bill. Okay, the water bill is for services that you've used. Okay, you're not going to pay the water bill this month. Okay, you don't have the money to, but you have received the invoice, you know that you've consumed this resource, so you do have to do an entry to accrue for the payment of these expense in the future. A lot of these expenses many times are not paid because there's cutoffs in the accounts payable system to where we don't cut any checks past the 25th or whatever the case might be. You don't have to physically pay for the invoice, but you do have to set up entries to record the expense in the period it should have been paid or where the services were used up or consumed. Okay, so we have to recognize the revenues and the expenses in the period they were used, earned, consumed, whatever the case might be, regardless if the payment is received or paid. Okay, so that's the concept of the matching principle. Now, accountants prepare what is known as the worksheet. Okay, the worksheet basically pulls together all of the information needed to enter the adjusting entries and be able to calculate our adjusted balances to prepare our financial statements. Worksheets are not a financial statement. This is just a tool to be able to prepare our financial statements. It makes it an easier process to be able to come up with the numbers that we need for the preparation of our financial statements. Okay, many accountants prepare the worksheets because they are very helpful in planning the adjustments and preparing the financial statements. Or ordinarily, only the accountant uses the worksheet. It's just for internal use. For that reason, most of the worksheets are usually prepared in an Excel document, which is what I'm going to be using to show you how to complete it. Okay, so the textbook does a wonderful job in explaining adjusting entries, which are posted to the general ledger in the same manner as any entries. So we have our general journal entries that are done that we've already covered in prior chapters, and now we have adjusting entries, and the process is the same. We're going to enter them in a journal. The only difference is when we transfer the information from the journal to the general ledgers, in the item field, we will be writing the word adjusting because we do need to identify what kind of an entry is this. If it's left blank, it's a regular entry. In this case, we have adjusting entries, and then in future chapters, we're going to cover closing entries. Okay, so when we are preparing the worksheet, we're going to prepare the trial balance, we're going to prepare the adjustments, we're going to prepare the adjusted trial balance. These are my amounts after my adjustments. And then we're going to extend the account balances to the income statement or the balance sheet. Okay, we're going to total the income statement and the balance sheet columns, and from the worksheet, we're going to compute our net income or net loss for the period. Okay, so there's a lot of information. Please make sure that you do read the entire chapter. Do all of your homework problems. They're there so you can gain practice, a little bit more knowledge about what we're doing. The more you do it, the better you're going to get at it, and the more you're going to comprehend the material. Remember, the highest grade is always retained. So let's look at what this problem entails. Okay, so it says we're going to be doing correcting worksheet with errors. It says a beginning accounting student tried to complete a worksheet for Joyce Lee's tax service. The following adjusting entries were to have been analyzed and entered into the worksheet. The worksheet is shown below. And then we have 4 adjustments. Okay, so it contains errors. The accounting student that tried doing this did it wrong. Okay, so we have to figure out what's wrong. Okay, well, if we look at our adjustments are 955, 955. We are in balance. If we look at our adjusted trial balance, we've got 13,160, 13,790. Our debits don't equal our credits, which trigger that we're out of balance. Okay, so this is the data that is given to you. I have copied it over here, my trial balance. That's our starting point. As of this point, my numbers are correct because the accountant hasn't done anything at this point. What the accountant did was fill out the adjustments column. Okay, and that's where the accountant made the mistakes. Now, you have to figure out the errors. I personally don't like to figure out what other people did. Okay, I'm not going to waste my time figuring out, well, this should be over here or that should be over there. You know what? This is what happened. I'm going to do it myself because I know I'm going to do it the right way. Okay, so what I'm going to do is I'm going to look at the item, post the adjustment, and then compare it to what the student did down here to see if we have the same thing. Okay, so letter A, it says the ending inventory of supplies as of March the 31st is $160. So we're looking at supplies. Okay, so supplies had a beginning balance of $525. Supplies is an asset account. We own the supplies. Now letter A says your ending supplies is $160. Okay, so let's get our magical calculators out and do some math. So according to the problems, I started off with $525 in supplies. And according to the adjusting entry here, it says that I have $160 remaining. That means that I have used $365 of supplies during the period. The $160 is not the amount of the adjustment. That is the amount of your ending supplies balance. So once again, we have supplies of $525 to start off with. I am left with $160. That means I used $365 of supplies. Now what is going to happen to my supplies account? Okay, my supplies account increases with a debit and it decreases with a credit. Well, my supplies account decreased by $365. That is the amount of supplies that I used during the period. Now, where do I keep track of the supplies used the entire year? Remember, we keep books for 1 year and then we do the closing process and then we start fresh the following year. So we accumulate data for a year's worth. Okay, so in this particular case, we use $365 of supplies. Where do I keep track of the supplies that we've used? We always hit an expense account. So I have used $365 of supplies. So that means I am going to debit my supplies expense by $365 and I'm going to credit my supplies $365. Now let's look at what the student did. If I look at the entry, the student recorded the amount of $160, which is incorrect. That is the ending balance of your supplies. That is not the amount of your adjustment. You have to calculate the amount of the adjustment by getting your beginning balance less your ending balance, and that will give you the adjustment amount of $365. Okay? Letter B. Letter B deals with unexpired insurance. So it says unexpired insurance as of March the 31st is $520. So what does this tell us? This tells us that we had prepaid insurance, which is a very common practice in businesses. Usually we pay our insurance up front for a year. So in this particular scenario, we have unexpired insurance of $520. So let's look at our prepaid insurance. Okay, so prepaid insurance, we have $930. That is our beginning balance. Okay, so we have $930 as our beginning balance for a prepaid. Now the amount of unexpired insurance, that means that this insurance has not been used up, is $520. So that means that during this period, I used up $410 of insurance. That is the amount of my adjustment. The unexpired insurance is your ending balance. I have $520 of insurance I have not used. So we have to figure out how much of it has been used. We get the beginning balance minus the ending balance of $520. So that means I have used up $410 of insurance. Now, prepaid insurance is an asset account with a normal balance of a debit. If my prepaid insurance decreases, then I would need to credit my account, and in this case it's $410. This is letter B. Okay. Now, if I have used up the insurance during the period, what account do I debit? The offset for using supplies, prepaid, advertising, anything of that nature will always be an expense account. So in this case, we have an account called insurance expense. Okay, in there, I'm going to go ahead and I'm going to put a debit of $410. The normal balance of your expense accounts are debits, okay? Because the debits increase the account balances. So I've got a debit for my insurance expense and I've got a credit for my prepaid insurance. Now, in letter B, the accountant did it correctly. They debited 410 and they credited 410. So the second transaction had been done correctly by the accountant. Let's look at the third one. Depreciation of office equipment, $275. So they're telling you the depreciation amount. You don't have to calculate it, okay? So when we have depreciation, that means that we have used up the equipment and it has lost some value because of its use, okay? We will always debit depreciation expense for the amount of the depreciation, okay? So we're going to have depreciation expense debit, okay? That way we know how much the usage that we had on this piece of equipment cost us in our books. And the amount is $275. Depreciation expense gets debited. It's an expense account. Now my credit when handling depreciation will always be accumulated depreciation. Now accumulated depreciation is a contra asset account, okay? It keeps track of your depreciation and it is always located below the asset. So office equipment is the asset. We don't touch that amount ever. That is how much you paid for the equipment. Below that, we have the accumulated depreciation account, which is where we keep track of the usage of the equipment. Okay? To calculate the book value of the equipment, you get the office equipment less the accumulated depreciation, and that will give you the book value. Okay? So in this particular case, we are recording the depreciation. We debit depreciation expense and we credit accumulated depreciation for the $275. So that is letter C. And if we look at letter C, the accountant, instead of hitting accumulated depreciation, they hit the actual assets, office equipment. We do not touch the asset. The office equipment is only used to keep track of how much you paid for the actual equipment. You record the equipment at cost. Now, to keep track of the depreciation, we have the accumulated depreciation account. Okay, and that keeps track of how much my asset, which is the office equipment, has lost value because of its use. So if I want to calculate the book value, how much is this piece of equipment worth in my books? I'm going to get the cost of the asset, which is the $5,450 for the office equipment. I would subtract the accumulated depreciation of $275. And now I know that in my books, this piece of equipment is worth $5,175. That is the book value. Okay, and that is important in case during the year we want to sell our asset. We need to know what it's in our books for and if we're going to sell it for a gain or a loss. Okay, so in this particular scenario, the student had recorded it to the incorrect account. They recorded it to the office equipment instead of the accumulated depreciation. The offset, the 275 debit was correct. The only thing that was incorrect was the account used for the office equipment. Okay. Okay, so last but not least, we've got our salaries and wages earned but not paid as of March the 31st. Okay, so we have some employees that worked. The cutoff for the payroll was not met, which means, you know what, the end of the month fell on a Wednesday. We cut checks on a Friday. So I'm not going to cut my employees' checks, but I know that they've worked and I know that they've earned $110 in salaries. Okay, so I know I owe my employees $110. Okay, so I'm going to go ahead and I'm going to credit my salaries and wages payable for the amount of $110. Remember, a payable is a liability account. These accounts are used to record debt, money that we owe. I owe money to my employees. How much money do I owe? I owe $110. Now remember, liabilities have a normal balance of a credit. Okay. Now why do I want to do this? I want to do this because my employees worked this month. Thus, I incurred salaries and wages expense this month of $110. If I don't do this entry, then I'm going to record this salaries next month in the incorrect period. And we don't want to do that. We always need to ensure that the revenues and the expenses are recorded in the period incurred. So I'm going to set up an accrual for those wages so I can be able to pay them later. So I put some money aside into my salaries and wages payable, and I'm going to go ahead and I'm going to debit my salaries and wages expense, okay, because I need to record the expense of $110 for the salaries earned, okay. So let's see what the accountant did. Salaries and wages payable 110, salaries and wages expense 110. Okay, so they had recorded the transaction correctly. So we found some errors in what the accountant did. Some work was done correctly, other was not. So we've already revised the work, and I'm going to go ahead and I'm going to add my debit column, and I'm going to add my credit column, okay? And that they both gave me $1,160. Remember, debits must always equal credits, okay? Now what happens after that point is you're going to calculate your adjusted trial balance, okay? So your adjusted trial balance is basically your updated balance after your adjustments, okay? Now, if an account did not have an adjustment, then you basically just roll it over. So cash was not adjusted. I'm going to just carry that over, okay? Accounts receivable was not adjusted. I'm going to carry that over. Now supplies was adjusted. I started with 525, and then I have a credit of 365, which means I would need to subtract 365. So I need to manually calculate my balance for supplies. So I'm going to get my 525 minus my adjustment of 365. That means I have $160 left in supplies. The same thing for your prepaid, okay? You had 930 in your prepaid. I'm going to supply the insurance expired of 410. Now I'm left with $520 in prepaid insurance, okay? Office equipment was not touched, okay? Now look at the balance. All of the balances are in the debit column. Why? Because the accounts are assets and the normal balance are debits, okay? So even though I have a debit and a credit, my debit balance is still greater than the credit. Therefore, my ending balance will be a debit, okay? Office equipment is also an asset with a normal balance of a debit. I've got $54.50, okay? Accumulated depreciation, we said it's a contra asset account with a normal balance of a credit. It's the opposite balances of an asset account. Okay, so in this case, we have a credit of 275, and that's all we have. So we're going to put it on the credit column. Accounts payable, no adjustments. We're just going to carry that over. Salaries and wages expense, we started off with 0. Now we have a credit of 110. We're going to bring that over. The capital and the drawing account were not touched, so I'm just going to copy the information over. I'm sorry, this should be on the credit side. And then the withdrawing should be on the debit side. Very good. Professional service revenue is a revenue account with a normal balance of a credit. No adjustments were made there. I'm just going to go ahead and credit it. Okay, salaries and wages expense. This has a normal balance of a debit. Expense accounts have a debit normal balance. So for my salaries and wages expense, I started off with 1,420 debit, okay? Then I added another debit, which means I need to add of 110. So now my new balance in salaries and wages expense is 1,530, okay? That is the new amount of my salaries and wages expense. Your salaries and wages expense increases throughout the year as you pay or your employees earn money, okay? Advertising expense was not altered, so we are just going to transfer it. Rent expense, no change was made, so we're just going to copy over. Now let's look at supplies expense. We had a beginning balance of 0. Now I have a debit of 365. My new balance will be 365. Phone expense did not have any adjustments. Utilities expense did not have any adjustments. So I'm just going to carry those forward. Remember, expense accounts have a normal balance of a debit. Okay. We have insurance expense, 410. We have an adjustment there. We had zero balance. Now we have 410. Depreciation expense office equipment, we had 0. Now we have 275. We're going to carry that forward. And last but not least, we've got miscellaneous expense. We have a debit of 175. Okay. So that is the last entry we have. Let me copy my totals over here. Okay. Now we're going to tally up our debits and our credits. Remember, the adjusted trial balance needs to be in balance. Okay. So I've got 14,065, 14,065. We are in balance. Now the student over here in the adjusted trial balance was out of balance. So there was errors here that we needed to fix, which we've already done on this side. Now from this point forward, it's a piece of cake. Okay, we've already done all of the difficult work, which is calculate your adjusted trial balance. Remember, your adjusted trial balance is your trial balance minus your adjustments. That gives you your adjusted trial balance. Now, let's recall, what do we put on an income statement? There's two things that we put on an income statement. Number one, we put our revenues. Number two, we put our expenses. Okay, so I'm going to first target what is my revenue account. My revenue account is professional service revenue with a credit balance of $5,700. I'm going to mark that off because I know that that goes on the income statement. So all I have to do is transfer it. Okay. What else do I put on my income statement? I put all of my expenses, and I've got quite a list here. Because I'm using Excel, I'm just going to go ahead and copy and paste. Okay. So I've already used up all of these items. Those go on the income statement. Okay. And let me change the color to blue. That way these tie to the income statement. Okay. So what have I transferred to the income statement? My revenue account of 57 and my expenses. Now let's tally them up. You are not going to be in balance. Okay. We are not going to be in balance. Okay. That's okay. So we've already transferred my revenues and my expenses to the income statement. Everything else belongs in the balance sheet. Okay. So we're going to go ahead and we're going to transfer. This is a debit. This is a debit. And then these are credits. I'm just going to transfer them over to the balance sheet section. Okay, so I've transferred everything from this top section. These are the amounts that go in your balance sheet. So all I did was copy and paste that over to the end in the appropriate columns. Okay, so let me tally up my debits and credits. Okay, and we notice we're not in balance. Should we be panicking at this moment? Okay. Should we be panicking that we are not in balance? Let me see. Let me see if I copied everything correct. 1725, 960. Okay, here I didn't copy. I copied the wrong one. Okay, so this one should be 160. And then this one should be 520. So I should be copying these amounts right here. What did I copy? I have no idea. Let me see. Let me recopy. Copy. Paste. Okay. And then these should be copied. I don't know what I copied. There we go. And then that one's 125. Okay. So let me double check my figures that I copied them from here. I should be copying my numbers from the adjusted trial balance, students. Okay. So let's copy it from here. And let me just make sure that you see. I don't know. I copy it and it gives me the wrong amount when I copy it. Let me see. You see? Okay, so I guess the copying is not working. Well, maybe I need to copy and maybe paste as values. Yes, let's do that because I guess it's copying formulas and then it's recalculating. So let's just, if you're using Excel, make sure that you copy, and when you paste as values. That way, if there's any formulas, the formulas don't get messed up. Okay. Okay, so now I'm comparing, and it's very normal for us to make errors as we're doing it, but we need to check our work. So I'm checking my work to make sure that I transferred everything good. Now everything makes sense. Okay. So I guess when I was copying the formulas, it was messing up the calculations on the formula. So I just decided to copy the values. Okay. So now let's see what we've got. We've got 4,125 debit on the income statement, 5,700 on the credit side. So that is a difference of how much? 5,700 minus 4,125. That's a difference of 1,575 between the debit and the credit on the income statement. Let's remember that number. Now on the balance sheet, I've got 9940 minus 8365. We have the same difference. We have a difference of 1575 between the debit and the credit in the income statement and the debit and the credit on the balance sheet. The differences should be the same. Now we're going to make it balance, okay? So this side needs 1575 to balance, and then this side needs 1575 to balance, okay? Now I'm going to retally up my numbers, and let's see what we get. Okay. So now I'm in balance. My income statement, my debit equals my credit. My balance sheet, my debit equals my credit. Now what do these numbers represent? That plug that we put there, okay? That 1575 on the debit side of the income statement and that 1575 on the credit side of the income statement represents your net income, okay? That's what it represents. The difference between the two is the net income that you have generated, okay? Remember, revenues minus expenses, which we have 5,700 in revenues, minus your expenses of 4,125 gives you a difference of 1,575. That is your income. Now, if the numbers were to be in the middle, okay, if the numbers were to be in the middle, then we would have, okay, a net loss. Let me change this real quick. So if the difference is in the two middle numbers, okay, then we would have a net loss. Why doesn't it copy? Okay, let's see. Okay, if your difference or your plug was in the inner amounts, the credit for the income statement and a debit for the balance sheet, then that means you would have a net loss instead of a net income. If the numbers are in the outside, the debit for the income statement and the credit for the balance sheet, then you have income. Okay. Now from this worksheet, now I know that this information goes on my income statement. I have net income of 1575, and this information over here goes on my balance sheet. Okay. So we can easily prepare our financial statements with the worksheet information provided. Okay. So the whole point of this worksheet or this particular problem is to show you the information being updated from the trial balance. We record adjustments and we calculate the adjusted trial balance. That is the ending balance. Once we have the adjusted trial balance, we use these balances to prepare income statement or our balance sheet. On the income statement, we have the revenues and the expenses. On the balance sheet, we have everything else. Okay. You're going to have a difference in the bottom. If the difference is in the outer numbers, then you've got income. If it's in the inner numbers, then you've got a loss. Okay. The difference between the income statement and the balance sheet should be the same. Okay. And then once we calculate our net income, then we are in balance at the bottom. Okay. So I hope this serves as a good example of how to account for the adjustments using a worksheet and how to utilize the worksheet as a tool to prepare your income statements or your financial statements, I'm sorry. Okay. Please make sure that you do complete all of your homework assignments, you practice, you read your book. If you have any questions or concerns, please do not hesitate to contact me. Please be descriptive on your messages. Send me an email with the screenshot or the link to the assignment so I can be able to look at what you're doing. Show me step by step what you're doing so I can be able to review it and provide guidance. Okay, so that is it for this lecture. Until next time, have a wonderful rest of your day. Bye bye.